This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Moody's lowers credit ratings for 10 regional U.S. banks and says it may downgrade major lenders. Meanwhile, lenders in Italy slump as Meloni's government approves a tax on extra profits of banks this year. And China's exports fall for a third straight month, thanks to slower global demand, while imports plunge in a new blow to the nation's economic recovery. Welcome to Bloomberg Surveillance. You're watching the Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, we don't love the words U.S. bank and sell off together, but that's what we're getting. But hey, finally, bonds acting as something of a haven for your portfolio today.
Yeah, perhaps a little bit of a reverting back to some sense of normal. But then again, you don't want downgrade in that vocabulary either. And that's exactly what you're getting coming out of Moody's. This time not on a country basis like you did from Fitch Ratings, of course, last week, but from a regional bank's perspective. Is that banking turmoil that we saw a couple months ago rearing its ugly head again? Well, the futures seem to think so. Down about 0.3% already in pre-market trading. We're seeing some pretty broad losses, not seeing much of a bid into any individual stocks or the index broadly. 45.24 on those S&P futures. But Dani, to your point, seeing a bid into the Treasury market, perhaps pairing some of the moves that we have seen kind of in the opposite direction in the last couple of sessions. What's interesting to me, though, is if you look at the front end of the curve, you're not seeing much change in the U.S. bond market. Look at further out, and the 10-year yield, that's where the volatility is to the downside, I suppose, when it comes to yields. Down already 7 basis points this morning, 402 we'll call it, on the 10-year yield. But look, a lot of this is coming from what happened overnight in Asia. You saw a massive sell-off in China off that data you were just talking about, Dani. The Hang Seng Index down 1.8%, the regional underperformer in the Asia Pacific Index. And at the same time, getting some weak employment data and wage data coming out of Japan as well. That's creating weakness in the Japanese yen and Japanese assets broadly, giving a little bit of a tailwind to the dollar this morning, stronger by about 0.4%. The currency pair there, 143.06, Dani.
It really feels like a morning where the hits keep coming. In the futures market trade, which unfortunately I was awake for around 2 a.m. London time, when that Moody's downgrade came out, you did see futures turn. You did see them start to selling off. That continued into the European session, and then we started to digest the Italy news that they would be taxing windfall profits. We're going to get more into that in just a moment with our reporter. So in terms of what's leading European equities down, it's the FTSE MIB. It is Italy. This is all Italian banks here falling by more than 1.5%. A Goldman Sachs index of Italian banks is now on track for its worst day since March, since the SVB blow-up. That's the kind of levels we're looking at for Italian stocks. Meanwhile, that flight into duration, Kriti, you noted in the U.S., it's happening in Germany, too. It's happening throughout Europe. The long end of the curve is getting a sizable bid. And at the moment, German 30-year yields are dropping 11 basis points, just a little bit less than that. But it's off the back of yesterday, this huge sell-off that took yields at one point in Germany in the 30-year, touching their highest since 2014. So we are getting a little bit of the opposite of that. It's a little bit of the banking nerves. And Kriti, just worth mentioning, about an hour or so ago, we got an ECB consumer survey that did revise down inflation expectations. So all of those feeding in to stocks selling off and bonds being bought.
Yeah, a lot of things going on right now, both the European and the American markets. We're going to walk you through it, but let's start with the big story this morning in banking news. Moody's cutting the credit ratings for 10 small and mid-sized U.S. banks, also signaling potential for more downgrades when it comes to the major banks. Joining us now to walk us through it, Bloomberg's Leo Kane-Sherper has all of the details. Leo, what do we need to know here?
Yes, so Moody's has basically given 3 reasons for this rating action. First of all, higher funding costs. As you know, customers are switching to higher yielding deposits, and that drives up costs for banks, the cost that banks pay on these deposits. Second of all, higher capital requirements that were proposed by regulators last month, and Moody's basically said some banks might struggle with that. And then finally, Moody's also flagged lending exposure to old offices. You know, this has been discussed many times before, but now Moody's has taken a rating action based on that risk. And I think it's quite interesting to see we had some high-profile analysts scrapping their recession calls for the US recently, and this move just shows you how fragile the overall environment is.
Yeah, it's not great for corporate bonds. It's not great on a week. We're also going to get bond auctions, too. Look, at the same time here in Europe, banks are selling off, specifically Italy, if I can find my words. We had the government approving this windfall tax. How big of a surprise was this?
Yeah, so it was the first thing I saw on my phone this morning, and it definitely took me by surprise. UniCredit and Tesla shares have plunged about 7% this morning, so I think that shows you how much of a shock this was for the wider market. And we have to wait and see if Italy remains an outlier here, but I think it's worth mentioning. In the run-up to second quarter earnings, we had a big debate in the UK with some Labour MPs also bringing up the idea of raising windfall tax further. So I think Italy's move today has definitely kept that debate going.
Yeah, a lot to digest here. And of course, to Dani's point earlier, you're already seeing such a massive market move in those Italian banks. Bloomberg's Leo Kane-Sherper all over our banking stories for us. Over in Asia, China's recovery shows more signs of weakness. Exports plunging over 14% in July from a year earlier. That does mark the worst decline since February of 2020. For more, let's bring in Bloomberg's Justina Lee. Look, Justina, we knew the Chinese economy was slowing. We knew the exports were slowing. Why do we care about this now?
Yeah, I think it really underscores the magnitude of the challenges that China is grappling with here. Because on one hand, you have slowing global demand, which kind of drove that plunge in exports. But at the same time, I mean, a longstanding concern among economists this year has been the weakness in consumer demand internally in China, even after the COVID reopening. And I think the falling imports number points to that. At the same time, we also got news today that a property developer called Country Garden might be missing bond payments. And I think that also points to the challenges in the property market there.
And how is that feeding into what we're seeing in the overall market, the trade today, Justina? Because already, I mean, it was a tough one with some of the banking news we were talking about.
Yeah, exactly. I mean, we're kind of seeing a classic flight to safety day here in markets, and especially true of kind of like Hong Kong and Chinese stock markets today. We have seen shares falling. And I think at the same time, one interesting thing is like China also weakened the fixing around which their currency can fluctuate. So that might be a sign that they're also going to tolerate some softness in the yuan, and that's one reason why the dollar is also trading higher today.
Okay, Justina, thank you very much for that. Justina Lee from our Bloomberg Markets team. Elsewhere in earnings, SoftBank shares closed higher after the group's Vision Fund eked out its first profit in more than a year, driven by the global tech rebound that helped lift the valuations of some of its investments. Joining us now is Bloomberg's Tom McKenzie. Tom, I mean, redemption for the Vision Fund. What were some of the numbers here?
Redemption, at least for now, yeah. And part of that obviously helped by the fact that markets are becoming a little less concerned about the higher interest rate environment. And also the hype around AI and the technology gains that we've seen year to date have obviously helped the portfolio of businesses that SoftBank has invested in. So they've posted a profit for the first time in a long time. The Vision Fund, over around $425 million US. That's helped reduce the net losses across the group broadly. The paper losses for SoftBank companies like Alibaba, Deutsche Telekom and T-Mobile as well. Interesting, we've been hearing from the CFO on the earnings call, talking to analyst investors and saying, we are now ready to be a little bit more aggressive in terms of investments, potentially saying and describing this position as being defensive and offensive. They've talked about the fact that they've pulled back on some of their Chinese investments and that they have about $8 billion in capital to spend on future investors. So they're getting a little bit more positive about the opportunities, particularly, they say, around value in artificial intelligence and potential growth there. A lot of this, though, the spending power, will also depend on what happens with ARM, of course, in their IPO.
Yeah, and now that you mentioned that, let's go there. You perhaps are seeing some good news when it comes to the SoftBank story, but perhaps some losses when it comes to ARM ahead of that planned IPO. Tom, why does this matter? Walk us through the details.
Yeah, the chip designer, of course, that SoftBank hopes to IPO potentially as soon as September. As you say, coming out with a loss for the most recent quarter, $66 million US. Look, Kriti, this won't come as a big surprise to you that the reason for this is the inventory build-up in semiconductors. ARM, of course, is very exposed to consumer products. So think, of course, of the chips that go into smartphones from Samsung to iPhone. And we see there has been, of course, a slowdown in terms of the demand, the sales of smartphones. So that's proving a drag for ARM. The hope for SoftBank and other investors, of course, in ARM is that the AI story will come to fruition, that some of the products that they're designing around AI will end up driving revenues and profits going forward, even as that demand for smartphones starts to slow. On the IPO, we're still waiting for more details on that. We don't have a date yet. They're hoping to raise about $10 billion US, and that would give ARM potentially a valuation of between 60 to 70 billion US dollars.
Tom, What a treat to have you on the show. Thank you so much for joining. Tom McKenzie there with the latest in the tech world. All right, coming up, we're going to talk more about earnings. This one is a major blow. It was for Glencore. The firm's half-year profit plunged 50% amid easing in commodity prices. We're going to discuss that next. And J.P. Morgan's Marko Kolanovic not willing to throw in the bearish towel yet. He says a soft landing is, quote, far-fetched, just after the firm's economists scrapped their recession call. We're going to have more on that next. Plus, we're going to catch up with Kevin Gordon, senior investment strategist at Charles Schwab later this hour. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London with Kriti Gupta in New York. Now, Glencore has reported its half-year profit, and it fell more than 50%, with disappointing Chinese demand weighing on commodity prices. Liesl Hill, Bloomberg Metals and Mining editor, joins us now. Liesl, what do you make of this profit drop? Because it's something we've seen from some of the other commodity giants. What did you make of Glencore specifically?
Yeah, that's exactly it. So on Glencore's side, we saw them flagging a drop in coal prices. Cobalt was another thing. Like the other miners that we've seen, Rio Tinto, Anglo American, they also had some inflationary pressures, pushing up costs at the mines around the world. And then Glencore in particular has this massive trading business, which, like the other traders, Trafigura, Vitol, just saw these absolutely eye-watering profits last year when we saw energy prices spiking and swinging so sharply. And basically the message from Glencore, and that we've seen flagged from some of the other traders, is that life is getting back to normal. They're still making quite a lot of money, but those kind of crazy profits are probably over for now.
Yeah, that 50% drop isn't exactly a encouraging number, but at the same time, they're dealing with that takeover fight with Teck Resources. What is the latest there?
Yeah, so not too many more details. The latest twist that we had in this fight, if you remember, in February, Teck announced that it rejected a takeover offer from Glencore. They kind of went back and forth. There was a bit of drama. And then in June, the latest twist was that Glencore announced it had made a bid just for Teck's coal business. So we understand it's offered around $8 billion just to buy Teck's coal business. And the plan is to put Teck's steelmaking coal assets with Glencore's thermal coal assets and then eventually spin that out into a new company. So the message from Glencore today is they're still very interested in doing that deal. And one of the ways they've signaled that is they've actually withheld $2 billion that they would have ordinarily returned to shareholders in dividends as kind of a war chest in the hopes that that Teck coal deal is successful.
Certainly a lot to digest. Liesl Hill, thank you as always for walking us through a crucial story. It really does have ramifications around the world. Another major earnings story we're watching is Bayer. Shares are falling after the firm cut its sales forecast for its crop science and pharma divisions. Bayer writes in a statement, quote, crop science registered a significant decrease in sales that was mainly due to lower volumes and prices for glyphosate-based products. Based on the current development, we have lowered our outlook for full year of 2023. Let's bring in Bloomberg's Tim Lowe for a little bit more information. Tim, look, on the surface, these forecast cuts aren't exactly good news. Is there any good news from the earnings report?
Well, there perhaps a couple of rays of hope. Within the crop science division, there's the herbicides, which is glyphosate-driven, Roundup, etc. That's been crushed this year. The glyphosate prices have just been really bad. The seeds business, which is really where a lot of the intellectual property is and genetically modifying, the corn has been going up. That's good. Soybeans, not so much. It's been kind of a mixed bag around the world. A lot of bad weather in the planting seasons and whatnot. Long term, if you look at glyphosate prices, the ticker we have on the terminal, it's gone up a little bit in the last couple of weeks. It's still got a long ways to go, though, if it's going to be a source of real growth for Bayer as it was in the last couple of years.
Tim, what about the overall sort of drug division? We've talked a lot about the crops and the impact there. What did we make of Bayer's results in that regard?
Yeah, on the drug side, Bayer has a pretty fundamental problem coming in the next few years. The two big blockbusters of recent years, Xarelto and Eylea, are both starting to face a lot more competition. They have some new drugs, a cancer drug. They're growing fast, but at best, in the near term, it's going to be kind of a flat picture for the pharmaceutical sales. The big question is, how are they going to fund future growth there? And that's where the bigger picture questions start coming in about the whole conglomerate setup of Bayer and whether it makes sense. You have a new CEO, Bill Anderson, who came in June. He's a classically a pharma guy. He was at Roche for years, and investors are just kind of parsing every word he says at this point to try to gauge what he views as the long-term approach. He's been so far keeping his cards close to his chest, talking a lot about eking out incremental improvements at the company by improving the culture, being a bit more innovative. But that's going to take some time to really move the needle, I think. So it's a lot of questions still swirling.
Tim, while we got you, I got to say, one of the things I'm most interested in hearing about this earnings season are what some of these pharma companies have to say about their weight loss drug. Novo Nordisk, which has Wegovy, is going to be reporting later this week. I think we're either getting Eli Lilly today or we got them yesterday. How big of a boon is this to the pharma industry, some of these weight loss drugs that we're hearing about?
Well, I mean, you're talking about, these could be some of the biggest drugs of all time in terms of money and demand. It kind of remains to be seen. The global picture for demand, obesity, etc. It's a pretty clear and not particularly rosy picture. So that suggests that there's a lot of need globally to handle obesity, to handle the effects of obesity. These drugs are coming in and they're growing like crazy, but they're still really new, and there's a lot of questions about whether people can take them indefinitely, what some of the side effects might be. So it's almost like the start of a gold rush or something in a sense.
Yeah.
Obviously.
Yeah, the struggle to keep up with demand, I mean, that just kind of tells you where we are. By the way, our very own in-house earnings expert, Kriti Gupta, reliably tells me that Eli Lilly earnings are today. So there's that question answered. Tim, thank you so much for joining us. That's Bloomberg's Tim Lowe. All right, coming up, stay underweight stocks. I swear that wasn't meant to be a pun. I did not know we'd be going from weight loss to this, but stay underweight stocks. That's the view from JP Morgan's Marko Kolanovic as he calls a U.S. soft landing, quote, far-fetched. We'll have more on what he had to say. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London with Kriti Gupta in New York. All right, so one of Wall Street's current bears isn't throwing in the bearish towel quite yet. It's JP Morgan's Marko Kolanovic. And he has a note out, it hit last night, saying that the idea of an economic soft landing is far-fetched and maintain his recommendation, Kriti, to avoid stocks. So specifically, he said we disagree with the market's expectation that a soft landing is the most likely outcome, also saying central banks are unlikely to ease in the near term, QT will continue, and the base case is for an economic slowdown. It's interesting, Kriti, to see just who is kind of capitulating on their bearish call and who is not, especially within the very own house of JP Morgan.
Yeah, I'm still kind of wrapping my head around kind of this role reversal you've seen across Wall Street on really turning some of their calls. The bulls are now bears and the bears are now bulls. But to your point, there is a little bit of internal infighting, it seems, as well. The chief economist, Michael Feroli, last week had scrapped his call for U.S. recession. He actually wrote, quote, the likelihood of contraction has diminished in recent months. A relatively quick resolution of the debt ceiling has taken one type of financial crisis risk off the table, which is an interesting concept, Dani, simply because the risk of that debt ceiling crisis, yes, it shook markets a little bit, but from a market participant's perspective, they tend to kind of brush that off until the last minute.
They have, and I mean, maybe that's why until really this week and a little bit last week, you've seen equities be able to move higher. And that's why a lot of these bears have had to capitulate. But again, I will say it, even though Mike Wilson kind of said, I got this call wrong, he's still sticking by his call. He was with the surveillance team yesterday, that you need to be more selective, that it's risky out there. Marko Kolanovic, he's not letting go of the call. And look, it is easy to get married to your call, especially if you got it right last year, saying that things would sell off. But if the economists are moving in a certain direction. Again, I find this really interesting. They're surely looking at the same stuff that only the economists, it's only this really strategic capitulation that we've seen, not necessarily the strategists.
Yeah, and it really comes down to, it feels like from a economist perspective that you were pointing out, it's really the fundamental story, but there is market plumbing to be thinking about as well. It's not as simple as, well, the economy is growing, so the stock market should grow as well. It's not as easy. If it were, I think we'd be out of a job, Dani. And that's, I think, why you're starting to see Mark Kolonovich pay attention to other things like the balance sheet, like the expansion, and other factors that really go beyond just the success of the economy.
Or we would have a different job. We would try to trade the thing itself, which,
That'll
I don't
go
think
well.
either of us necessarily want to do. Yeah. Okay, well, there is one call that both JP Morgan and Goldman are currently in agreement with, and that's that last week's sell-off in treasuries. It's gone too far. Goldman specifically saying by duration, by 30 years, the yields had closed near multi-year highs. But that is what we're seeing, Kriti. A lot of things going on in the market today. But perhaps of what we're seeing, this huge rally lower by 10 basis points for U.S. 30-year yields is some of that. Some people saying the sell-off last week just went too far.
Yeah, and I mean, this is something you're seeing across Wall Street. A lot of the banks, to your point, really agreeing on this. JP Morgan, Goldman, Morgan Stanley. Let's see if people actually follow those calls right now, Dani, because you are still at the point seeing volatility.
Well, let's see if our next guest agrees with that. We're going to be speaking to Kevin Gordon, Charles Schwab, Senior Investment Strategist, next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Moody's lowers credit ratings for 10 regional U.S. banks and says it could downgrade major lenders as well. Meanwhile, over in Italy, lenders slump as Meloni's government approves a tax on the extra profits of banks this year. Meanwhile, in China, exports fall for a third straight month thanks to slower global demand. Imports, on the other hand, plunging in a new blow to the nation's economic recovery. I'm Kriti Gupta in New York with Dani Burger in London. Dani, there's a lot of cross currents here. The banking crisis now suddenly back in focus and moving markets.
Yeah, I thought we were done with this. We're not done. We're never done. I mean, even though we have seen some U.S. banks sell off some of their loan book, that's not enough to satisfy Moody's. I'll tell you, the ratings agencies are really out for blood these days. Last week it was about U.S. sovereign debt. Again, this week just U.S. banks. And to make matters worse, we also had the surprise news overnight that Italy is approving a windfall tax to the region's lenders. So in the European session, overall equities are down, but they're led lower by the FTSE MIB and by Italian banks. The FTSE MIB down more than 2%. All of those kind of worrisome developments, what that means for the American corporate bond market, the bond market in general, for banks, is sending a bid into debt, into government debt. We saw last week a lot of it selling off, so some of that is reversal too. But Kriti, for the moment, Germany 30-year yields are down by 12 basis points. That will be, if it holds, the biggest drop since April of this year.
Yeah, it's interesting what you're seeing in the kind of the duration play here, the 30-year that you point to in Germany, but also stateside, seeing some volatility here as well. Look, when you look at futures trading, you're already seeing a pullback, even on the micro basis, a major sell-off across all sectors, all individual stocks, not a ton of green on the screen, and I think really accelerating in the last 30 minutes or so. You are seeing futures down about 0.5%, 45.17 for our radio audience on those contracts. But Dani, again, back to the bond market, the 10-year yield down 8 basis points. Again, and we're only 30 minutes in to this morning. We're right around that round number. Technicals playing in here, 4% on that 10-year yield. I think what's interesting, though, is what happened overnight, because we talked about this weak data coming out of China on the imports and the export side, taking the Hang Seng Index down about 1.8%, really the underperformer in the entire index, and even seeing some weakness in Japan as well. Surprise, surprise, with weaker wage data and employment data, sending the yen again down to 143.08 against the dollar. Strength for the greenback higher by 0.4%. There's a lot of cross currents here. We have the perfect guest to break it all down for us. Joining us right here on set, Kevin Gordon, Senior Investment Strategist over at Charles Schwab. Now, Kevin, we're already seeing a little bit of a sell-off. Today's trade makes a lot of sense. But let's zoom out here, because we've seen some conflicting calls. We were just talking about these kind of internal divergence over at JP Morgan, where on the one hand, if the economy is recovering, does that mean the stock market will recover as well? your take?
Well, I think what makes it difficult when you talk about soft landing and kind of the broader soft landing for the entire economy, we haven't been thinking about it that way because our view and our thesis really since the beginning of last year has been we've been suffering from these series of rolling recessions throughout the economy. And so, traditional soft landing to us is sort of off the table because you've had key segments of the economy, housing, the goods sector, parts of manufacturing that have already kind of entered their own recession and actually are starting to show signs of recovery. At the same time now that you're starting to see some cracks develop in services, some cracks develop in labor, which those were the key areas that were kind of holding us up last year, and that was the positive offset. So I think that's what makes kind of the market call and the economic call sort of at times in conflict with each other, because you could see how some parts of the market will struggle definitely from disinflation, even though that might sound counterintuitive. But if you lose pricing power at a time when labor costs are still sticky, that's where I think the dynamic between the market versus the economy is. So it makes the call, really tough, especially when you're trying to gauge out, into 2024.
But there's a difference between recovery and resiliency. Which one is it here? Are you net, given the parts of the economy that are succeeding and the parts of the economy that are kind of lagging, net, is it resiliency or recovery?
I think resilience for now. And, maybe this is just kind of too technical, but I think resilience to me is a bit more of a defensive posture as something, as opposed to an actual recovery that's durable, that's a little bit more aggressive and you're actually moving yourself out of a recession. But again, that's what makes this tough because even within something like housing, you've seen a pretty incredible recovery in something like new home sales, but existing home sales have still declined. Now you have price pressure that's coming back with the home price decline itself. Max drawdown was really nothing terrible when you compare it relative to history. Certainly when you compare it to the housing crisis, which is maybe not a fair comparison. But I think even within certain segments, you're not really getting kind of those major drawdowns and major sources of weakness that you would typically see in a recession. So that's what makes part of this just really unique relative to history.
Can we say where we are in the cycle at all at this point, Kevin, or is it just kind of a big question mark?
I think if you're going to base it, really the broader recession call for a lot of people is based around the labor market. So if you want to just use that metric, there are a lot of indicators within labor that still look late cycle. You could look to the cuts to hours worked, the decline in temporary payrolls, which tend to lead overall payrolls. You can look at sort of the the quits rate and the pace that's coming down at. And again, there are positive offsets in labor just like there are for the rest of the economy. But I think until you get a stabilization in leading indicators like the ISMs, until you have more of a durable recovery in housing, and then that starts to feed through to the broader labor market, that's when I think you can be a little bit more sure that you're not as late cycle, as some of the indicators would suggest.
Okay, the other confusing thing about this market right now is bonds, because we started this year by saying it was going to be the year of the bond market. That obviously hasn't happened. We're also looking at a sell-off last week to try to digest this new supply that's going to come to market. Kevin, where do bonds sit in a portfolio in terms of hedges? Are they still useful? Well,
our fixed income team has been really pounding the table on this and really trying to, take advantage of, if it makes sense for your portfolio, obviously, as the investor, but if it makes sense to sort of extend duration, kind of take advantage of yields at these levels. Because I think, one of the interesting parts of this cycle where we're at right now, if this is a new kind of durable bull market, even if it's different and kind of weaker relative to history, is just the relationship between stocks and bonds from an earnings yield perspective. So you look at the spread between something even just like the 10-year yield and then what you earn on equities is basically near flat, and you're kind of hovering at a 20-year low. And for a considerable amount of time, especially post-financial crisis expansion and in the secular bull market that we've been in, you've kind of been able to make an argument, even if multiples got stretched, that stocks were relatively more attractive when you compare them to bonds. That's not really the case as much anymore. So it's not that stocks are unattractive, but in our perspective, even within the equity universe, you want to be properly diversified, but you also want to expand that out to broader asset classes, and especially in the bond market, bonds are back and they look pretty attractive. So we've been really pushing for just kind of exploring that to the extent it makes sense for a portfolio.
I want to bring it back to the stock market here because Dani might like bonds. I prefer the stock market. You talked about the labor market specifically. We're seeing a lot of these union contracts really push some of the margins of the biggest companies, not just in the United States, but around the world. Is that an issue? How hard is that to model when you're talking about sticky wages and just how much that's eating into even the bottom line of UPS, which is reporting this morning?
You know, it's hard because unionization rates just in general are just not as high as we've seen. You know, you always hear the comparison back to the 70s and the 80s when we had kind of more, stickier inflation, especially on the wage side. But I think that when you kind of take the broader picture of labor costs themselves, that's kind of, that's an area of inflation that hasn't readjusted as much to the downside. And you're starting to see, nascent signs of it, specifically with the productivity and the unit labor cost data we got last week. There was a lot of cheering about that. Number one, it's revised a lot. Number two, a lot of that was basically just due to cuts to hours worked. So that works great in the near term, and if companies can kind of protect margins that way and protect productivity that way. But if you continue to see, more aggressive cuts to hours worked, and then eventually that leads to layoffs, that's when you get more of kind of a vicious spiral for the broader economy and the broader labor market. But I think, it's great at grabbing headlines and certainly garners a lot of attention. But when you compare it to the broader kind of unionization relative to when we saw, decades ago, it's not really the same. But I do think from the Fed's perspective, wanting to bring down any sort of signs of wage stickiness is still key. They're still much more focused on the upside risk to inflation than they are the downside risk to the economy or what a recession might bring. So I think that's the bigger picture that we have to keep in mind right now.
For this earnings season, we are more than halfway through. See, Kriti, I can talk about stocks too. We are more than halfway through the earnings season. Kevin, have you learned anything you didn't already know about the health of corporate America through these results we've gotten so far?
I think it's much more actually the response from the market that hasn't been not terribly surprising, but I think telling in the sense that, one of the first things I look at when I pull up Bloomberg is the data from Bloomberg Intelligence, looking at that spread and sort of the excess return from companies in a stock perspective relative to the broader market when they beat estimates, whether it's sales and earnings or a combination of both. And right now that's basically tracking at flat, meaning there's no outperformance. So there's no edge if you beat estimates. And to us, that means, number one, you were probably fully priced heading into the earnings season. Expectations were pretty solid. The bar wasn't lowered too much. And then number two, I think, rightfully so, the market's probably shifting just more attention to guidance and what companies are guiding for the rest of the year and then into the turn of the year. So to us, that's more of an important development where you start to see, are there more significant cuts to guidance? Has revenue guidance actually started to come down, which I would actually put as more of an emphasis on rather than earnings themselves, because you're now in an environment from a broader macro sense where revenues are contracting, real revenues are contracting. So if that's the case, you have to start looking for companies that can actually outperform in that environment and that are seeing not only strong nominal revenue growth, but strong real revenue growth too.
So revenue growth, labor, Kevin Gordon of Charles Schwab covers it all. We thank you as always for waking up this morning and joining us. And we're going to continue that conversation, especially when it comes to earnings season. UPS reporting in less than an hour. We're going to discuss declining demand, higher expenses, and of course, that major labor deal. All of that next. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. UPS set to report its second quarter results at the top of the next hour. Investors will be eager for any details on the new tentative labor agreement struck recently with the Teamsters Union. Klaskow, Bloomberg Intelligence Senior Transportation and Logistics Analyst, joins us now. Waking up early. Thank you as always for doing that.
My pleasure.
Let's start with the earnings story here.
Sure.
Net, if you're seeing shipping volumes decline all around the world, we just got export data out of China that suggested the same thing. What is the read-through into UPS?
Yeah, so what we're expecting is UPS will have volume down, mid to low single digits. I think that's expected. You're coming off like creamy highs from last year during the pandemic. We're really going through a more normalization. That's actually good and bad. Obviously, low volume is obviously not a great thing because it's a deleveraging an asset-intensive network. But also the mix might actually be slightly improving. You might get more B2B and less B2C. So B2C is your home delivery. That usually comes with lower margins, higher costs. So the mix actually might be improving. But net, we're really not looking at 2Q. We don't really care too much about 2Q because that's in the rearview mirror. You might have heard they had this big labor deal,
Rings a bell.
Yeah. So they averted a strike, which is fantastic for UPS and its customers and its employees. But at the end of the day, it comes at higher costs, and UPS, will have to kind of mitigate those higher costs. Everyone knew that a new contract was coming.
Yeah.
I think that the expectation was probably it wasn't going to be as costly as it is. If you do a swag, it might have cost an additional $2 billion over the next 12 months. That's probably anywhere between 500 million to maybe 750 million more than what people were expecting.
Yeah.
And that could just be a drag on margins by up to 100 basis points. So we expect them to guide lower when they report earlier this morning for the full year.
Is that kind of what we're waiting for? Because intuitively, to your point, if you do have that higher wage contract, and by the way, they've set the tone for labor negotiations across the country, across the railroads, across logistics, which of course you cover. If they are arguing for more and you are seeing that pressure on margins, why are the stocks not taking a bigger hit?
Well, they have pricing power, right? There's really only two major players in the space in the U.S., maybe three globally. And obviously there's little niche players. There's U.S. Postal Service. There's local postal services around the world that do more local delivery. But in the U.S., if you want to get a letter from point A to point B that has to get there overnight, you're probably using FedEx or UPS. Or if you're you order yourself, I don't know, a T-shirt or sneakers and you need them the next day, you're probably going UPS or FedEx. So they do have pricing power. They are going to be implementing maybe, higher general rate increases next year to kind of compensate for these higher costs. Obviously, the large customers get to discount off that general rate increase. And there's going to be productivity things that they're going to be able to do. They're implementing more and more technology. I don't want to say they're going to be AI players, but they're probably going to implement.
Carefully.
I know. They're probably going to implement more technology to help kind of just whether it's internally through delivering a package or in the back office. So they're just going to implement more technology.
Hey, Lee, Dani here in London. Thanks for joining us. Look, when it comes to those price increases that they might pass on to the customer, do we have any sign about how much they can push this? It feels like we're in this really unknown space with the consumer at this moment, especially if they're starting to turn away from the goods economy and to the services economy. Even though they have pricing power, is there still a limit to how much they can really push through those higher costs they're facing?
Sure. So maybe for its largest customers, it might be a little harder. But UPS and FedEx are going after kind of the smaller middle market shipper. And those margins tend to be better because they don't have the pricing power that a large retailer might have. Like FedEx and UPS, or FedEx has totally pretty much stepped away from Amazon. UPS is slowly moving away from Amazon because, while that business is decent, it probably comes at a lower margin for UPS.
Now, if we are seeing this, again, this normalization in consumer spending, Lee, does it get back to really where we were pre-COVID? Because a lot of the conversation during COVID from a lot of these shippers from the Amazons of the world saying, look, once the consumer gets used to shipping everything, they're not going to stop. They're going to want to keep up this habit. Is any of that true at all? Or are we expecting volumes to just go back to what they were before the pandemic?
No, not in our view. We think this year is a reset. So, everything's being recalibrated to a normalization, if you will, from the pandemic. And, we expect growth, whether it's revenue, earnings, volume, all next year. UPS will have to pull some levers to offset the costs that they're dealing with this new labor agreement. But, we're actually relatively bullish. While people haven't said that there's going to be a fantastic peak season, we do think there's going to be some seasonality going into the fourth quarter, which will be very good. That is also a little bit has to do with easier comparisons because last year was a terrible peak season. From a normal seasonality standpoint. So we think there's going to be more seasonality this year. The consumer continues to be resilient. resilient. We remain relatively bullish on the macro outlook. Even though we have been in a freight recession for quite some time, the consumer still remains strong, and we're expecting a rebound in demand for most freight next year.
One of the, I think, fun facts, my favorite fun facts about UPS is that its largest customer, one of its largest customers, is Amazon Logistics. But I'm curious if you're looking at Amazon earnings, I'm gonna get a little nerdy here with you, bear with me. If you're looking at Amazon earnings and they have this kind of long-term shift away from their e-commerce business towards their cloud business, for example, what is the read-through into UPS that depends on them for that business?
Yeah, so I mentioned earlier small to mid-sized businesses. So if UPS can fill the void that Amazon leaves with small to mid-sized businesses, shippers, then it is a win-win for UPS.
Yeah. But they already tried to do that.
They're doing that right now.
Yeah.
It's happening right now. You can hear it.
Yeah.
It's happening right now. And that's what they're doing. And they're going into more profitable verticals like healthcare.
Yeah.
Healthcare, obviously, if you need drugs from point A to point B, it's maybe temperature controlled.
Yeah.
Like during COVID, it had to be the vaccines had to be frozen. So it's more complicated, and with complexity comes margins. So they're focusing on profitable verticals like healthcare. They're focusing on small to mid-sized shippers, and that's not like, oh, UPS is doing something different. FedEx is doing it.
Yeah.
DHL is doing it. They're all doing it because they realize that they want to go after these more profitable businesses, and there is a great market out there that's not Amazon. I mean, Amazon's a fantastic company. They're building a logistics network, and that's really for them just to lower their overall costs.
Right.
But we don't see them as a competitor because as of right now, they're not picking up. They're just delivering.
Yeah, and they have that spillover effect, of course. Lee Klaskow all over everything UPS and logistics related. We thank you as always for joining the show. He, of course, works for Bloomberg Intelligence. Watch for his analysis as those earnings drop in about 10 minutes. Coming up on the show, a look at some of the market-moving events to watch throughout the day. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London. Kriti Gupta is in New York. Let's get you set up now for your trading day and a look at what's ahead. Fed Presidents Patrick Harker and Tom Barkin are both going to be speaking at 8 a.m. Eastern Time. Then we're going to be getting the U.S. wholesale inventories at 10 a.m. And then we're going to get another auction today. The Treasury's 3-year note offering of $42 billion at 1 p.m. And then earnings are going to continue. We're going to get UPS. We're just talking with our Bloomberg Intelligence team about that. Eli Lilly, Lyft, and Rivian all reporting today. Interesting to see what the demand for that Treasury auction will be. But of course, Kriti, the big ones come tomorrow and the next day with a 10 and 30-year auction.
Dani, a lot of things, a lot of cross currents to get through, but I want to say when you're looking at the market here, you are seeing some broad declines, except for this one stock that seems to kind of be defying gravity this morning, and it's Paramount of all companies. PARA for our radio audience is the ticker. It's actually higher by over 3%, 3.4% to be specific, trading about $16.63. This comes after their streaming business actually showing a lot of improvement. Dani, you don't hear that a lot right now, that a part of the media business is doing very well. And speaking of that media business, let's take it to Amazon because they've got their hands in a little bit of everything. Amazon has their Amazon Prime Video, their logistics business, and of course their cloud unit as well. Well, right now the stock is taking a hit of about 0.7%. Remember, they're also dealing with a court case with FTC. Lena Khan, of course, has it out for Amazon. Next week, they're going to be pushing in a final last time Hail Mary kind of call to avoid the antitrust lawsuit. We'll, of course, see how it plays out and cover it live for you on Bloomberg Television and radio. And sticking with that big tech trade, let's talk about Tesla replacing their CFO after 13 years at the EV maker. Dan, a succession story in the works. Tesla shares down by 0.8%.
I got to say, the quote of the day comes from our Bloomberg story on this from Gene Munster, partner at Deepwater, who says he's done a 13-year tour of duty working for Elon, which is like working 50 years for anyone else. Kriti.
That is brutal. I wonder if he'll put that on his resume. Certainly something we're going to be watching and, of course, monitoring the shares as it has a broader readout throughout the rest of the market. Futures down about 22, down about 0.5%. Stick with us. That does it for Early Edition. Surveillance is ahead. Good morning. This is Bloomberg.